Welcome to this webinar, The Power of Privatized Banking. Did you know that banking is the most powerful business in the world? What would happen to your economy if you learn how to use privatized banking? Let me show it to you. And no matter how much money you make, your results will improve. Turning liabilities into assets. Financing as a wealth creation strategy. Most people borrow because they have to. Wealth creators borrow because they want to. An introduction to the benefits of becoming your own banker. The way you finance your life always impacts your wealth, for better or for worse. The first principle to increasing your wealth is to understand the power of your cash flow. Everything that we do in economics, or everything that we buy, is finance. We either pay somebody else for the use of their money, or give up the interest that our money could have produced had we not decided to spend it. That's where the concept of loss opportunity cost comes. Every financial decision we make impacts every other financial decision. They are all tied together. So we're gonna see a nice exercise of two ways to finance a car, and we're gonna use two cousins for this. They're going to buy a similar car, but they're going to go to wealth-related seminars to learn ways to buy those cars. Cousin A seminar use government-promoted qualified plans like 401ks, 403bs, 412is, IRAs, SEPs, KIOS, etc. He selects a 401k for the immediate tax deduction his companies match, and to allow his money to grow tax deferred. Cousin B, on the other hand, he goes to a seminar where liquidity is emphasized. So he takes control of his cash flow, and he identifies ways to recapture wealth transfers and use that money to fund and build an Internal Revenue Code 7702, where his assets will grow tax advantage. So we're going to see that cousin A is a debt manager because since he went to this seminar of government-promoted vehicles, his money is tied up. He doesn't have access to his money. So they're going to buy an identical car that is going to cost them $20,000, and they're going to finance it at 5%. Now, as I was saying, cousin A is not liquid. His money is tied up, so he's got to go to the corner bank, and he loans the $20,000 from them, and he commits to monthly payments, and he makes them religiously, $461 a month. Now, cousin B, he learned about the Internal Revenue Code 7702, so he disciplines himself and he builds the family bank, and he borrows from his bank or his family bank the $20,000 with his policy as collateral, and he also commits to the same payments, $461 every month. So after making payments for 4 years, They both end up with a depreciated car, 4 years of use, beat up, but it's got a value of $9,000 at that moment. Now, they both produce 22,108, represented in 20,000 to return the principal that they borrow, and 2,108 to pay for the use of the money. Now, in the case of cousin A, this money goes down the drain, goes to the rat hole. Why? He doesn't see that money anymore. In the case of cousin B, this money represents an asset. All that money returns to his family bank. And along with the $9,000 represented in the car, he's sitting on $31,108. That's pretty good. He's on cloud 9. In the case of cousin A, he can only show the depreciated car. And the rat hole grew with his money. Think about this. When you make a payment, lease, or finance to a bank, or you make a cash payment to a bank, do you ever see that money again? I don't think so. Actually, that money goes down the drain, goes to the rat hole. What would happen if you own the bank? This is what happens when you own your own bank. Every payment that you make, all that money goes back to your bank instead of their bank. And you earn triple interest, triple compound interest on your money. First, you earn interest on the money, on the principal that you pay into your bank. Second, you earn money on the interest you would have paid to other banks. And third, you earn interest on that interest. So when you finance your next car, you will either increase your net worth or decrease it. You could be an asset manager, a debt manager, like in the case of cousin A, or an asset manager, like cousin B. But you do have a choice. If you became curious in learning more about this concept, please contact me. Thank you for attending the webinar.